Okay, gentlemen, thank you for joining us for this month's Fireside chat.
Thanks, Rob. Good to see you.
Glad to be here, Robert and
Uh,
Chris.
so, look, the world's an interesting place at the moment. Markets have been very volatile. And I think that probably leads us into a very important point is why have we chosen to be more active at the moment in regards to equity portfolios? So, Chris, I might get you to talk about internationally, why we're positioned ourselves that way.
Cool. Thanks, Rob. So I think in terms of thinking differently and how we look to set up portfolios, and again, like we can't we don't have crystal balls. We can't make explicit forward assessments on exactly what will happen. But I think with regard to how markets have been traversing over the last couple of years, we've been fairly consistent in our comments around the fact that the markets have been very momentum driven and one directional, and then feeding off that very concentrated sort of focus on what's winning and what's not. And so obviously, I mean, that goes against hundreds of years of investing in terms of what does play out in markets. So you've got two options at that point when you're in the middle of it. You can adjust and try and make some short-term gains, or you can invest for the long term in terms of tried and tested approaches and make assessments along the way. And I think if we think about portfolios today, obviously we are being more active, not just in terms of our approach, but in terms of our review, our communication and commentary and discussion amongst what's happening. And obviously in relation to our monitoring of underlying fund managers as well in portfolios and what they're doing. They're technically our first line of defense. When you are using active managers, you do get the benefit of them providing that first quick line of defense where they can move things very quickly and very swiftly as they see things firsthand. And then obviously we take stock of that and assess whether we need to make any other explicit changes from a portfolio perspective.
From that perspective, Chris, I might just get you to talk about on the screen at the moment, we've got a graph of the US tech sector and how it's underperformed pretty much everything else. We might talk about the index composition in the US or even globally, like the fact that the US is such a large part of the global index now and how much technology takes up of that index.
Yeah, so they're good questions, Rob. So with regards to the US, US is 72% odd of MSCI World. So, I mean, historically it was 50, 55 roughly, and for a long, long time. And obviously over the last few years in particular, it's ramped up to 72% of world equity markets. So that means, I mean, historically what happened in the US happens everywhere. Now it's predominantly only the US in terms of what moves markets. And then interestingly, within that cohort or within the US specifically, if you were to add up technology and communication services, which is another sector that is broadly representative of tech stocks, you've got circa 40% of the market being tech. And so if you wind back the clock decades ago, that would have been sub 10% for a long time. And then it sort of sat in the mid-teens roughly. And we're now talking sort of 40 odd percent directly in tech and tech related stocks. If you look at some of the indirect thematics as well, it's probably a bit higher than that as well. So that's the skew we're talking about in markets today. And it's been one-way traffic on that front for the last few years. But obviously, what we've seen more recently is a reversal of that, and investors seeking to place money elsewhere outside of that very narrow and concentrated part of the market.
So just on that, on the screen at the moment, we've got a graph of the US tech sector versus the Germany broader share market. And as you can see, the tech sector's got sold down quite significantly. And the German share market's actually been a beneficiary of that capital rotation.
It has, yeah. So and it's a few things there. So investors obviously looking for under-owned or unloved parts of the market. So things trading really cheaply. And so Europe has traded a significant discount to the US for some time. And that discount was actually became more exacerbated more recently, particularly certain European countries as well. And the impetus more recently there is not just the fact that Germany was trading cheaply, but obviously the Germans have broken with a long-held fiscal constraint they had in place, where they now have approved the expenditure of money in their economy, where they will spend and borrow to spend money. And so you've got a fiscal impetus in Germany, as well as the ECB cutting rates. So those two things have put a bit of a rocket under European equities and German equities in particular. But as you can see, the market there is much more diversified from a sector basis versus US heavy benchmarks or even tech heavy benchmarks as well.
So, Clint, what about bringing it back home to Australia? What does the Australian index look like? And why are we looking to be more active at home with our equity exposure?
Similar to the reasons that Chris mentioned, obviously we've reduced, not eradicated it totally. The top 10 make up about 50% in Australia, with Commonwealth Bank and BHP approaching or around about that 10%. I think, Rob, in the main, it's harder to get away from those big ones in Australia just because it's a much smaller pool. And even going to the active guys, we find that they're full of fear about underperforming the market anyway. So a lot of the times, even the active guys are playing in the same spot as the passive type investments. So we do have to go a little bit wider into those smaller company space and into some of the long short funds just to try and get some protection and differential in the returns. But same fact remains that, you've got 50% in the top 10 stocks in Australia. And then because you've got that constant inflow of super into Australia, we used the Commonwealth Bank example last time, Rob. That's more an example of how expensive Australia is. It's not an example of differentiating away within the Australian market. The Commonwealth Bank example was that Commonwealth Bank's trading at about 22 times earnings versus Lloyd's, I think it is, that trades at about 7 times earnings, with all their metrics very close to being comparative with Commonwealth Bank. So Australia, even the active managers are living fear of underperforming and people just following the returns, Robert.
Indeed. And in investment parlays over the long term, that generally doesn't work. But anyway, so on that, we've got inside the MDA, we run an income equity strategy. We run a growth equity strategy. So from that perspective, how have these sort of strategies looked over the last quarter, I guess, where things are starting to get interesting, and how do these strategies diverge from each other? Chris?
Yeah, Rob. So I think obviously we run that on the Australian share side, but also the international side. And I think I'll probably talk to the international side just because the results are more stark and more contrasting, given some of the skews we just talked about. Where in Australia, income and growth nuances are probably a little bit tighter. So stocks in Australia can be both income and growth and vice versa. Offshore, you've got very clear delineation between stocks that produce income and stocks that don't. And so if I talk specifically about the international equity growth and equity income portfolios as a contrast, so if you look back over like the last 1 and 2 years, the growth portfolio has done exceptionally well, as you'd expect, because it's packed full of the names we sort of talked about. So the tech names, the communication services names, it's very US heavy centric portfolio. In contrast, the international equity income portfolio, because of its income bias, largely has a value skew. And so when you do have that value skew, it means you largely can't own much or any of those names. So you have a big skew to Europe, and then a big skew to industrials, healthcare, and a whole range of other sectors. And so whilst that's still done well from an absolute return perspective, it's very strong return over the last couple of years, where you start to see some divergences over the last sort of quarter or so. So specifically, maybe in the month of February, you got a negative return for the index and a negative return for the growth version of that portfolio for international equities. And you've got a very strong positive return for international equity income. So it wasn't just a minor positive return, it's actually a very strong positive return for the month. And then that's obviously started to flow through the 2-month, 3-month, and 6-month numbers now, just with regard to how that portfolio is positioned. So it's not that we're targeting Europe in that portfolio or targeting non-US exposure. It's just by virtue of the income requirement in that portfolio, that means a significant exposure to those other markets that I mentioned. And so right now, that's a bit of a sweet spot in markets because those stocks are very much in favor as investors start to rotate away from some of the winners from the last couple of years.
Yeah, good. So, Clint, from an advisor's perspective, when you're building a portfolio for clients, how do you determine whether they're going to be an income-based equity strategy or a growth-based equity strategy?
Pretty straightforward for me, Rob. It's simply retired versus non-retired or approaching retirement. Obviously, once people are retired, they need to start generating the income to pull out. Versus being non-retired, they don't really need the income, so we're more growth focused. And just because it's growth, it may be just a lower allocation to growth for those guys that aren't retired. But as soon as they need an income stream, I'm looking to switch them from growth in the main to being able to generate an income. And that's the same in the diversified balanced portfolios versus balanced pension, where the balanced pension are more focused on generating an income and have more of those international income or Australian share income exposures that flow through into them.
Yeah, and I suppose those income-based strategies, by their nature, are actually less volatile as well, which which sits well with retirees, as opposed to, if you're young, you're at work, you don't even look at your super. It's a different world, so we need different solutions. So we've just spoken about the fact that the equity markets are selling off. Now, one of the things we talk about a lot of is owning assets that aren't correlated to the equity market, so we don't get hurt when this, hurt as much when that happens, and investors are getting a smoother ride as opposed to whipsawed all around the place. So our alternate strategy is one of the things that we have as part of the portfolio for exactly that reasons. So what we might do is, Chris, I might just get you to talk about the Aspect diversified future strategy that we've got in the portfolio, and why we've got that, and how that sort of helps us achieve non-correlated returns.
Sure, thanks, Rob. So as the name suggests, Aspect diversified futures. You don't take too much out of the first two words, but the futures part is interesting. These funds have been in Australia for a long time. They're known as trend following strategies, or CTAs, commodity trading advisors, and they've been around a long time in what we call the more traditional alternative space. Why they've been sort of favourable to the Australian market in particular is that they're daily liquid. So they have a lot of liquidity. Not many old strategies have much in the way of liquidity or have delayed liquidity. These strategies are very, very liquid. Obviously trading futures and forward contracts in global markets across equities, bonds, commodities, and currencies. And so those are very deep liquid markets globally. And then when you apply futures to those markets, they get even deeper and even more liquid. Futures are a very efficient means of trading strategies. Their costs are low, are very efficiently traded. They're the positives. The negative of futures are futures contracts generally have embedded leverage. So you can get very big exposures with very small allocations. So what these strategies largely have, and it can look rather odd when you look them up and see a chart, they'll have 90% of their portfolio in cash, earning a cash return, and about 10% exposed to the futures trading strategy. Because it's levered up, they effectively get a full portfolio exposure that way. So what your return outcome looks like is 90% cash return. So today, 4% at core, whatever it is, or wholesale type rates. And then you get access to the futures trading strategy. And that futures trading strategy is trend following, as I mentioned. In trend following, there's short, medium, and long term. I know we like to frame long term in our discussions around 10 years plus, that sort of thing. In managed futures vernacular, long term is 12 months. Just to make that clear, short term would be daily, even hourly trading. So that's sort of the reference point there. And they're it's a computer system, it's a systematic approach with lots of smart people around it, putting in inputs and testing the system and finding new markets. And what they're trying to do is build a system that effectively angles towards new trends as they're emerging, and then buys more of that trend as it's playing through. So because of that trend following approach and because of the diversification, you actually get a very different return outcome from broader markets, and you generally get uncorrelated returns. So if equity markets are screaming ahead, this thing's probably going to be flat to maybe slightly negative, and vice versa some of those other markets. It's not to say that it'll always be negative in an upward rising equity market, because it does have an equity sleeve, but it does have significant diversification, and it is looking for trends both at the broad level, but also within that level as well.
Yeah. Okay. Excellent. So, Clint, gold's been making a bit of a comeback. More and more people are starting to talk about it. We've had an exposure for quite some time now. How do we get our exposure for our clients in gold in the alternates portfolio?
So for new and recent clients, we've started to use the NUG exposure. There was a previous video on that. Legacy guys that have been in there for longer have PM gold, which that was what that previous video explained, just the differences between what the holdings are comprised of, and that's why we made the decision to go to NUG, which is the Van Eck exposure. Obviously, we've harped on about the reasons for gold for quite some time. Those legacy guys, we've had that for a long time in there now. Some of those guys are up 170, 180% on their exposures. Even for the new guys, once we switched into NUG recently, they're up that was only about 2 months ago, end of January. I think those guys are up about 10% just over this very short term because, as Rob mentioned, gold is on the forefront of a lot of people's minds at the moment and is going great guns for the reasons that we've spoken about in the past. Inflation, just the world events, things like that are going on at the moment. Trumpy's tariffs and the goings on in probably that are coming up in the Middle East.
Yeah. Well, I noticed last night the S&P sold off nearly 5%. Gold was down about 1%, and in fact, it's clawed its way back today. So, so once again, it's only assets that are going to behave completely different. And finally, Chris, I might just get you to talk about the FX Global Alpha exposure and how they try to make a dollar.
It's a good question, Rob. It's a very complicated strategy, and I won't get into the weeds. Otherwise, some might fall asleep or eyes might gloss over. But it is a fun steeped in mathematics and unashamedly so. So they use very specific and very complicated mathematical techniques. Takes me back to my high school days, university days, around certain theorems that have persisted in statistics and maths for a long time. And they effectively apply that to a singular part of the market, and that's currencies. So we would refer to this fund as a global macro fund. Generally with global macro funds, there's discretionary, so a star manager picking trends or parts of the market to invest in. Then there's systematic, which is where a system does that for you. And generally global macro funds that are systematic will trade a wide range of securities and sectors. This one is specifically and only currencies. So that's their forte, that's their expertise, their core expertise. So it's trading currencies, futures and forwards, contracts on currencies globally, and looking for trends similar to what Aspect does, but it's using a very different approach to doing so. A lot of macro inputs, so a lot of smarts around this system in terms of the macro inputs that come in. And effectively, currency trading funds or currency in particular is a very hard place to invest because the factors that go into why currencies move are wide and varied. This is one of the most successful long-term funds in currency investing. It's had a very strong long run in managing currencies. The other benefit, much to your heart or close to your heart, Rob, is it actually can include gold in its portfolio. So it can invest in gold. It sees gold as a currency. And so it can invest with some limitations, some gold, where it thinks gold offers superior upside or potential defense to broader currency markets.
Gold is real money, Chris. The rest of it's pretend.
That's it. That's it. So I would have added that in there because we have some questions in the past around it being a currency fund only and it having gold in there as well. So, yep.
Okay, good. All right. Okay, now the final topic for today, I want to talk about the special situations portfolio. Obviously, and I actually just had a look at the performance of it over the last quarter. It's been substantially different to the index again, which is something we probably don't expect because over the long term, I think it will be wholly correlated to equity markets. But in saying that, the special situations is a fund where we're sort of taking positions in things that we like the short to medium term outlook, and there's certain themes playing out, and it should be included as part of your equity exposure from an asset allocation perspective. But what I might get you to do, Chris, is just talk about the China exposure that we've added to the portfolio in the last few months.
Sure. Thanks, Rob. So with regard to China, obviously it's been a hard equity market to invest in effectively since COVID. It's been a market where obviously due to the actions of the Chinese in particular, but then also in terms of the negative sort of feedback loop regarding US trade wars, economic sanctions and the like, you've had the Chinese market come under pressure. At the same time, Chinese economy has been slowing. So you've got some negative macro headwinds for Chinese equities in particular, and that has resulted in Chinese equities falling. As we've noted previously, markets can become rather irrational or exuberant at the top end. And this is a case where we identified that the Chinese equity market has had been sold off way too aggressively, a lot more than it should. So Chinese equities, by their nature, are actually more risky than other equities. So they should trade at a discount to US, European, and Australian equity markets. There'll be points in the cycle where that discount gets even wider. So that generally presents a trading opportunity, unless there's something fundamentally broken with the Chinese equity market. So in our assessment previously, we thought that discount was way too large versus not just history, but versus the risks embedded in the Chinese equity market. We got a bit of that play out in September last year, where some Chinese political or economic news was positive, and the Chinese equity market ratcheted very aggressively in about 3 to 4 days before falling away again. And we definitely saw that through the last few months, particularly in the month of February, where Chinese equities were up circa 12, 13, 14% in a month, where other equities were down. So we did
Part
see
of that rotation out of US, yeah?
that's it. So that big part of that was the rotation out of the US into other markets, under-owned markets or unloved markets, so into Chinese equities. And what sort of spurred that, or the catalyst, I guess, was DeepSeek. So it was originally around AI thematics. And so if you are an AI or technology investor, which a lot of the world is today, and you're looking for new possibilities or new upside in AI and tech, it's the one part of the market that foreign investors hadn't owned for some time. So DeepSeek drew attention for foreign investors to AI and tech stocks in China, and foreign investors loaded up pretty quickly. And so as they're doing that, they can singularly buy a tech stock or a tech ETF, but in some cases they're buying broader, like a China 50, China 100 ETFs or index. And so the broader equity market does benefit from that foreign investment flow. But it has shown us the positive, I think, out of that is that you go to a lot of briefings today, and a lot of people say that investors are on strike in China, foreign investors aren't coming back in, are going to come back in. It's worth noting that in investment markets, people are there to make money. And so where there are places to make money, they will go. So there's no such thing as something being uninvestable, people won't go. If something's trading cheaply and there's a catalyst for it going higher, foreign investors will come back, and they definitely came back in February, and that'll be the case going forward as well.
The investors coming back? Will investors come back to the gold mining space?
Well, this is an example of one of those investments that's taken a little, or themes, strategies that's taken a little while to come through, Robert. So obviously, we've had GDX in there, the gold miners index, for quite some time. We originally added it back in about 2020 or 2021. The original reason why was gold price and gold miners were quite correlated for majority of the time. They started to diverge in 2020, 2021. And the theory was that at some point that gap will look to close. It's been a little while coming, but the gold miners have started to pick up, which has been good to see. That exposure is up about 50% in the last 3 months or so. So it's starting to kick some goals now.
And finally, Chris, coming back to which I think is an interesting one that really leads off what you were just talking about, the exposure to the Asia tech.
Yeah, so that's the part that was, that was the part of the drove the Chinese and Asian thematic for the last 10 years, say, was the rise of these Chinese tech names. So your Tencent, your Alibabas, your Baidus, and the like. So as they became not just Chinese champions, but global champions or global revenue sources, they did rise aggressively over that 10-year period. They obviously were particularly hurt through the last 5 years as the backlash from China from a foreign investor perspective played out. But interestingly, those names, and even if you're maybe concerned around the Chinese economic outlook, that's fine. But those names are global champions now. Like, they have revenue sources all around the world. So whilst you might want to slice off a bit from your forecast earnings or upside in share price around the Chinese operations, the rest of the operations are actually in other countries. So they're actually multinational companies. And so that Asian tech ETF is a thematic in particular on those multinational revenue sources. It's also a play on AI in particular. I mean, the world, if you invested or know about AI, the two biggest leaders in AI are the US and China going at it, clearly well above the rest in terms of R&D investment spend and just the length of time they've been going at it. And it's sort of a battle between AI supremacy between those two parts of the world. So if you want AI investing or you want to be exposed to AI, the Asian technology market's the place to be. They have plenty of investment, both by private companies and by government-led investment as well. So Asia Tech is a prime example of a part of the market that was probably not well understood, probably tarnished a little bit more recently, but with some stellar names in the top 10, top 20 in terms of global stocks, global champions. And obviously that's performed well as part of this rotation.
Well, I mean, I remember when we were sort of looking at it, it was sort of sticking out the difference in valuation between the US companies, which was, in our view, very full, and then the Chinese, which were effectively doing the same thing. And the vast difference in the valuation was, well, it was just massive. So it was definitely an opportunity.
Yeah, it was pretty stark at that point, Rob. I think at that point, I remember US tech. I mean, peers have come in a little bit in terms of earnings and both price, but I think at that point, US tech broadly was at 40, 50 times, and you had some of these names, these Chinese and in particular Asia tech names, sub 20 times, and that was a big contrast to where they were historically. Before that, they were trading with similar sort of multiples to the US, but they'd come right back and right off, and it did present a trading opportunity.
Yeah, no, absolutely. Gentlemen, thank you very much for your time and look forward to catching up with you next month.
No worries.
Thanks, guys.
Thanks,
Cheers,
Keith.
boys.
See ya.